Welcome to Dr. Power Law, where we use academic research to explain real-world business, economics, and public policy. President Trump often talks about tariffs as income for the federal government. His administration has pointed to rising customs receipts and argued that tariff revenue can help finance tax cuts and reduce federal debt. And the money is real. U.S. customs duties topped $100 billion in fiscal 2025 for the first time. But that is the revenue collected at the border. What happens to the rest of the tax base after companies start adjusting to higher tariffs? A recent paper, Trade Policy Exposure and Managerial Adjustment Margins, gives us a way to examine that question. In this episode, we look at how tariffs can affect the U.S. corporate tax base beyond the revenue collected at the border. The study follows large U.S. firms from 2010 through 2024 and combines quarterly financial statements with changes in U.S. tariff exposure. Its main outcome is the corporate tax gap, defined as the difference between the federal statutory corporate tax rate and the effective tax rate a company actually pays. A larger gap means the effective rate sits further below the statutory rate. The measure does not identify one specific tax strategy. It captures whether tax outcomes change inside the same firms as tariff pressure changes. The main result changes sharply around the 2017 Tax Cuts and Jobs Act. Before the reform, firms with greater tariff exposure also showed wider corporate tax gaps. After the Tax Cuts and Jobs Act, that earlier relationship is almost fully offset, leaving the post-2018 relationship close to zero. More demanding time controls tell the same story. The evidence is concentrated in the same period as the tariff shock, and the earlier relationship largely disappears under the new tax regime. Why would tariffs show up in tax outcomes at all? A firm hit by higher import costs has several ways to respond. It can switch suppliers, raise prices, move production, cut other costs, or reorganize activity across its existing network. For multinational firms, the location of profits and costs is another adjustment margin. The paper calls this cost fungibility. Pressure arriving in one part of the business can affect decisions elsewhere when firms have room to reallocate activity. After the Tax Cuts and Jobs Act introduced rules such as GILTI and BEAT, that room became more constrained, and the earlier tariff-tax relationship weakened. Firms operating across more geographic segments show a stronger relationship between tariff exposure and the tax gap. The pattern also holds when geographic diversity is measured 4 or 8 quarters earlier, which reduces the concern that the operating structure simply changed alongside the current tax outcome. A company spread across more countries and entities has more internal locations through which it can respond to a trade shock than a firm concentrated in one market. Tariff revenue, then, is a gross fiscal number. It tells us what customs collected, not what the government gained after firms responded. In public finance, tax collections and economic incidents are different objects. A tariff can raise consumer prices, compress margins, delay investment, redirect sourcing, or change where activity is booked. Each response can move a different part of the tax base. Organizational flexibility matters too. A multinational with more suppliers, entities, and geographic options has more ways to absorb or redirect the shock. So if tariffs are supposed to finance tax cuts or reduce deficits, fiscal scoring should follow the whole system after firms adjust, not stop at the border receipt. The answer will depend on supply chain structure, firm flexibility, and the tax rules in force at the same time. Thanks for watching, and if you found this useful, please subscribe to the channel.